live? Okay, we're live. All right. Hello and good evening, everyone, and welcome to another episode of the Ringgit Plus Show Live, our special segment on Thursdays called Ask the Expert Anything. So this week we have Azril. Hello, Azril. How are you doing?
Hi, Kang. Good evening.
Okay, so we're going to be talking about something that would have been a little bit troubling to quite a few, more than a few investors in the last few months, I think. So if you've been catching up, let's just go straight into it. If you've been following, or if you have been invested in the Chinese tech companies, you would have realized that there has been a pretty major correction. I wouldn't say a crash, but year to date, some of the biggest tech companies in China have gone through a pretty big and steep drop. Some of them are 30-40% drops in the span of just not just span a few months. It's just over the course of this year. And if you actually went in and invested at the early part of the year, your position might be even in a much worse situation, right? So and that just doesn't apply to we can take a look at the slide for the first one. Yeah. Okay, cool. So yeah, and this is as a result, right? You're not just looking at the individual companies as itself, but rather any of the the ETFs, exchange traded funds or unit trust funds that have holdings within in these companies, right? So one of the most popular ones we're seeing here is KWEB, which is one of the most popular ETFs on Stashaway. Year to date, it's gone down 40%. So if you've been invested in like maybe February or March, your losses, your paper losses, not realized, your paper losses would be actually a lot higher, right? And honestly, like a lot of people have been, I know, approaching you, Azril. Some of our colleagues have approached you as well about what exactly is happening, and really like what should they do, right? So taking a step back, these kind of phenomenon is quite not quite common, but it does happen. And that you've done your homework, you've done your research, and somehow the market just goes against you when you're invested in it, right? So Azril, really, like what's happening in Chinese market? What should we do as an investor if we're invested? Because I think a lot of people are invested on platforms like Stashaway, on FSM1 unit trust. So yeah, no, take it away.
Thanks, Pang, for that introduction. And a little bit of a brief of what has happened over the past start of the year, right? Where you see on the chart here, just a reflection of the decline that we see from the Chinese tech stocks, right? Primarily, right? And the attribution that you can put to this decline can be on three factors, right? So the first is the fears around COVID-19 variant, right? The new Delta variant that is now also creeping into China, right? So we, of course, in Malaysia has experienced this a little bit earlier than other countries, but it's now also going into China, and as a result, has increased the number of cases in China. So this is a broad kind of sentiment decline, and as a result, you see that affecting the stocks price in China. So number two is the impact of the collapse of Archegos Asset Management Company. So this is a New York-based asset management company that has over-leveraged in the Chinese stock markets. And then as a result, when the market goes against them, they had to close shop, right, effectively. And as a result, sell off all their positions in this market. And as a result, has dragged the
ripple effect, isn't it? Yeah, because I think wasn't the total losses of that one asset management company went up to like $20 billion, isn't it?
Absolutely, yeah. So that's a madness that we see at Archegos, right? And more recently is the impact of the clampdown by the Beijing authorities, right, around the operations of Chinese companies in overseas operations. So as a result, they have to comply to new accounting requirements, and it has somewhat affected the reported numbers that these companies would have to disclose, right? But fundamentally, and then we'll see this and share this a little bit more later, is that we have not seen such market decline within the space. It's actually as a result of these sort of short-term sentiments, and this has caused this decline that we see since the month of March, right? Effectively after the Chinese New Year.
Yep.
So in terms of the positions and how it affects you, I would imagine some of you may be wondering, okay, well, this decline has been rather significant, but where is it affecting me, right? So for those that have invested in stash away ETFs or has an exposure specifically to Chinese related stocks on your unit trust funds, either via a platform such as FSM1, would have seen this decline, right? And would have seen this decline affecting you and affecting the performance of your assets, right? So this is where this is affecting you, and some of you, and I'm sure, and I've seen this in Stashaway forums, there's been a lot of noises around KWEB decline, right? And how the recent move by Stashaway to double down, to effectively increase the allocation to KWEB is causing a lot of anxiety among the investors. So you may be wondering, okay, well, KWEB, what are the allocations of assets or companies within this KWEB, right? So if you look at the top 10 holdings, as a fund, it has exposure across 50 different stocks, right? Internet stocks in China, where you see some of the really common names, right? And these common names are meant to be the same service provider that you will find globally, right? So if you are a user of Google, if you are a user of Facebook and Twitter, you would see the exposure of KWEB to be the same exposure of these companies with focus on the Chinese market, and therefore Chinese consumption growth expectations, right? And that is the nature and the strategy around this, right? Which is that these companies are, from a long-term perspective, are expected to grow as a result of the increase in consumption, the increase in income from China, the increase in growth of the economy. So from the fundamental strategy perspective, it's meant to mirror the growth of the Chinese economy, which, like what we have seen over the past 20 years, has been a miracle, right, in terms of growth. The ability for them to move from a lower income to a middle income countries, and the level of innovation that we're seeing within the market to move towards the high income nation. So then you may be wondering, okay, Azril, well, this decline has been significant, right? What is the prospect for the future, right? What are your thoughts around these prices movement? So our view here at Ringgit Plus is that this is a rather short-term decline, right? Because when we look at the fundamentals, right, we looked at three key trends. We are still bullish around the expectations of these stocks going up, right? And this is a collective of stocks, so we're not talking about just one stocks that we see earlier, right? So these are stocks that, like I said earlier, is meant to grow in tandem with China's population urbanization rate, China's rapid adoption of technology, and they have these things called the leapfrogging of technology. And this is fundamentally different. And we in Malaysia, for example, do not experience this as much, right? So we move, for example, from check to e-payment to then subsequently only recently e-wallet payment. For people and consumers of China, they move entirely from cash straight into mobile payment, for example. And that kind of leapfrogging and adoption of technology is nothing that we've seen in the other markets, right? So these companies are expected to benefit from that consumer change, and they're not. And they are very innovative companies, right, with exposures across the globe. And they're not a small size company. So if you looked at, for example, Tencent, Alibaba, they're already the fourth and the fifth largest company in the world, right? Just behind Amazon, Alphabet, and Facebook. So they're not your mom and pops or like a country-specific companies, but have global presence across the world, right? And are adopting new technologies like artificial intelligence, machine learning. So those all the big words that you've heard are adopted by these companies, right? And it's not likely to go away, because when we looked at the revenue growth, it's still going to grow rapidly. When we looked at the year performance, we see the growth to remain at 110%. And more so recently, we're starting to see some of these companies announcing record performance, right, from a revenue and net profit perspective. So fundamentally, we don't see much difference, right, on their capability to deliver growth, right? So ultimately, what is a function of a stock price, right? Fundamentally, it should be back to what a business is, what is the entity, and how the entity is going to grow. So the thought is, okay, well, if you are worried and you are fearful, I think our points and our thoughts is try to avoid doing this, right? Where you you buy on the high and sell on the low, right? One of the key fundamental principles of investing is so that you have to buy at low and sell at high, right? So if you are in a situation whereby you're thinking, wow, it is really low now, it has declined by 40%, should I be looking at selling? Well, the question may not be too straightforward. It depends on your financial position. And of course, you can speak to our financial planner on that if you wish to understand really what your cash flow position is. But if you're looking to invest for long term, then this is really not the right time for you to sell, right? In fact, this might be a time for you to top up some more,
It's
because
an opportunity, right?
Yeah, at the point when the price is really good. So if you look at the historical return, right? So if you have looked at the performance since creation, when we looked at KWEB again, based on the chart that we saw, this is the longer period chart, right? We have just captured effectively the year-to-date performance. But if you looked at the total performance, it has grown, right? It has grown quite substantially over a period of time, right? So it's 72% if you had invested since 2013. If you are long-term investors, you would have made 70%. Of course, you could have made much more, right, when the price is at 100. But this is where some techniques, and we'll cover this a little bit more, the techniques around diversification, the techniques around dollar cost averaging is very crucial for you to ensure that you are able to continuously ride on the growth of these assets over time, and not try to time the market, right? Because it's often, in my mind, rather a delusion, or rather a challenging exercise to undertake, which is to time the
Exercise in
market.
futility.
Yes. In fact, if you look at the PE ratio of these companies, it is absolutely at the lowest amount already to date, right? Of 17 times price earning ratio, which is really, really cheap, right? If you compare that with tech companies, and we are seeing a PE of these tech companies trading at 50, 100, and that's quite common, right? Even in Malaysia, we see some of the tech stocks. You're wondering how long it will take for you to pay back, right? The earnings, you need 200 times of the earnings being produced for you to get to that price of that stock, right? So that, to me, gives an opportunity. In fact, if you have extra cash today, you can look to actually top up your investments, or if you don't, continue to do dollar cost averaging, right? and be able to gain from
you
from
still
the
take
point.
advantage of the drop, right?
That's right. Yes. And we'll see some examples around that, and how that can be illustrated in a strategy, and how using dollar cost averaging would allow you to buy at a lower unit cost, and therefore buying more units, right? So one is diversification, right? So if you have invested in KWEB via Stashaway, your return is not going to be negative 40%, right? It's just going to be 20% of the allocation that you have in that KWEB. So if, for example, if I looked at my own Stashaway exposure from the start of the year, I only made a return that is negative 3%, right? As opposed to negative 40%, because my exposure in KWEB is just 20% of my portfolio, right? I still have exposure in the US, for example, when the growth is positive 10%, for example. And as a result of diversification, you're able to reduce the risk and also increase the return. So this is the chart here that we see. And effectively, these platforms that you're using today, right, the likes of the unit trust funds that we saw earlier, as well as Stashaway ETF, they have these that form of diversification, right? So one is they have multiple asset diversification, which means diversification across assets such as equities versus bonds, for example. It also has country diversification. So when we saw, for example, the decline in China, we see a rise in US market, right? So effectively, you're you're still making potentially negative return, but negative return is not negative 40%, right? As what we saw earlier. And number three is the industry diversification. What we see is that there's also allocation of multiple industries, right? So we're not just talking about Tencent as one company. We also talked about Alibaba within the logistic business, Tencent as a banking business. So there's multiple industries here, and there's enough diversification across those industries, and also company diversification, right? So there are 50 stocks within the KWEB portfolio. So there's sufficient diversification across company too. So what it does, it smoothens your chart, right? So if you had invested in KWB, you probably would be in example B, right? Asset B, where there can be instances where it declines all the way to, for example, 750 here compared to the price in which you bought it, which is at 10, right? But if you had sufficiently diversified allocation, you would be able to then smoothen the growth, right? And this is what we want to achieve, right? So that we don't get that kind of rapid volatility that we see among specific assets. If it had been, for example, buying Alibaba as a stock itself, then the volatility is a little bit much more significant than KWEB as a portfolio too, right? So this is the way in which you can really smoothen your return and make sure that return is a little bit more consistent. So that's number one, right? Number two is to look at dollar cost averaging, right? So this is again another way in which you can optimize your return further, right? So how do you do this? You do this by allocating a specific amount every month on a periodic basis. For example, it must not necessarily be on a monthly basis. It could be on weekly, it could be quarterly, it could be yearly. But the idea here is that you put a fixed, consistent amount on each month basis. So when the price moves, so for example, in the table that you see here, the price starts at 10. So with 1,000 ringgit, you would buy 100 units, right? So when the price goes up to 14, for example, in month number 2, you would buy only 71 units. So you're reducing your purchase in terms of number of units because with the same amount. But at the point when the price reduces, say, for example, to 8 ringgit in the month number 5, you're able to buy more units, right, at 135 units. So what does it do, right? So you'll be asking, okay, Azril, you effectively are just saying I should put a regular selling plan. But what that means is this, right, which is that you are able to reduce the average unit cost. Right? You're able to reduce the average unit cost by buying more units when the price is low and buy less unit when the price is high. So if I make a comparison between two type of investors, so one investor that put a lump sum amount of 8,000 ringgit, for example, in this example, and the price moves like up and down, right, to the point where it reaches back to the original level of 10, you would just have made 0%, right? So effectively, you break even on your investments, and of course there's some opportunity cost there, 8 months of your time, right? But here, if you are doing dollar cost averaging or putting 1,000 each month, you would have actually reduced your cost instead of 10 ringgit to 9 ringgit 61 cent, and the average price of your assets would grow to 10 ringgit and 6 cent. So what it does is that you're making a return that is 4%, right? So imagine this, the chart going out like that and then coming out like this, like what we're seeing with KWEB, you would have actually be able to make a higher return and optimize your return further. So this I would encourage everyone to do. And if you have more money, top up your money because it's a good time to buy because the price is cheap at this point. So that is my thoughts. And let me take a pause here and see if we have questions, and happy to take on further questions from everyone.
Well, there's definitely a lot of questions. Our producers behind the scenes are also telling us there are quite a few questions. So, wow, they're not even holding back. This is the first question, and we're gonna go straight into the Chinese market, right? So for FSM, for Fund Supermart, FSM1, sorry, the principal Greater China Equity Fund, that's one of the unit trust funds available there. There are MYR and MYR hedged versions of that unit trust. Which one should I go for? This very technical question.
I think a short answer to this is if since we're all here Malaysians and we have our expense and exposure in the Malaysian ringgit, so therefore you should look at getting an exposure that is MYR hedge. So what does that mean? It means that you do not take the risk from the foreign currency volatility. Yep. So if it's a China equity fund, that means you have exposure to the renminbi as a currency, or US dollar if these companies are listed in the US market. So therefore, I would encourage that you just get MRH funds, because what you want is the return from the assets itself, and not play on the difference in volatility in foreign
Mm-hmm.
currency, unless you have a specific view, right? Of your
Yeah.
view, for example, thinking that USD is going to be doing much better than Malaysia because of our political situation, for example. Then you may be thinking US is going to be better. Then maybe you don't do MIRH. But oftentimes they will reach a mean level, right? So
Right.
foreign currency exchanges goes on some level of volatility, but oftentimes it will not dramatically change unless the economic condition changes.
Right. Cool. Okay. So I think this is the next question is something that genuinely is very important, right? A lot of we've seen this with our conversations, offline and also with your clients. Uh, the biggest barrier I feel is emotion, right? That gets in the way of investment decisions. You can make a lot of um, analysis and homework, but then when you see the price drop at that level, you would probably start questioning a lot of things, right? So really, Azril, what's the best way to take emotion out of investment decisions?
Yeah. I think it's not easy. I think I would qualify that to be the first statement, right? And oftentimes we tend to be affected by the volatility that we see to our investments. So to me, what is important is to tie it back to the objectives of the investments that you have, right? So if you understand truly the different level of volatility that you should expect from different investment assets, then you would know some level of volatility is expected from the investments. So why am I saying this, right? So if you are investing for growth, then of course there's expected to be volatility and decline, like what we see with KWB as a case in point. In that instance, then it's rather easy to be emotional and thinking that you should exit at that point. But I think if the fundamental objective of that investments was to grow your money over time, then you should remove that out of the equation and continue to invest for the purpose of long term, and maintain to that objective that you have. Um, and that's easier said than done, of course, right? But to me, that has to be the approach that you take when it comes to investing. And if you need that funds for the purpose of short term, then you should not be looking at investing for growth, but
Investments.
rather look at investing with less level of volatility. So therefore, your emotions are not as affected
Right.
by the.
Yeah, and I think this applies both ways, right? Sorry, just to add on to that one, that really applies both ways. It could actually, emotions get in the way when things go south, and it also gets in the way when things go really well for you, right? And that kind of, like you said, right, like there's a lot of focus when it comes to your original intention behind your investments, and some cases with that we've seen as well is where it moves up in a trajectory that is up too quickly, and they're like, yeah, maybe I should take profit now, and then they lose out on the extra growth that they had originally planned in mind for a longer term. So that's really adding on to what you're saying, right? It's not just when things go red and you lose like 40% and then you decide to pull out your investments, your position. So emotion is just like you said. At the end of the day, it's just gonna be there, whether it's good or bad. And the key to it is really staying disciplined and stay focused to what the goals of the investment was. Cool. Let's go for the next question. This one, I think, yes, this is my question actually. Okay, Azrael. We talk a lot about KWB today, but one of the things that we always talk about is that different asset classes have different levels of volatility, right? And so when we see an ETF or a unit trust fund dropping 40% in the span of 6, 7, 8 months, that's probably not something that a lot of people are expecting, right? So, my question really leading up to this one is really, how do you determine what's an acceptable level of volatility for the different asset classes, right?
Mm.
Crypto, we see 50-60% up and down in a week
Yeah.
versus this one is in a
Yeah.
day, sorry, in a few months, right? So different levels of different asset classes have different levels of volatility. So in your opinion, like what is acceptable for each of these classes?
So you can use a bit of a rule of thumb, right? In here, I would have some indication of what that percentages should be depending on the asset classes. Like what you said, Punk. For crypto, for example, 50% decline or increase is considered acceptable level of volatility, right? So I'll start maybe with crypto first and moving lower to the level of volatility. So crypto to me, 50% downward and upwards is acceptable, or rather,
Yeah,
this is a level that can happen, right? In fact, there are instances whereby it could go negative 90%, and I've seen some of those that have invested in ICO, for example, that have seen that kind of decline.
yeah,
Uh, if you invest in equity as a specific asset itself without diversification, then you should expect also 30 to 40% level of volatility, right? Or standard deviation, the term that is used within finances in industry.
yeah,
Uh, if you have a sufficiently diversified asset, such as unit trusts and ETF, then that should reduce, right? From 30% to 40% of ETF or UT, that should reduce to 20% at max in terms of volatility. You should expect, right? So there's also talks now around the creation of ETF for crypto. So potentially what we see is that the decline of 50% of crypto is not going to be as acceptable if you do a ETF of crypto,
yeah, exactly.
which should be negative, around 20 to 30% too in terms of exposure, because there's already diversification, right, between the different cryptos in that ETFs.
Cool. Yeah, I think that those are some benchmarks that we can probably follow and tweak based on our own risk appetites, right?
Yeah.
Cool. Okay, so another one. Oh, this is a really good one. Okay, so a lot of people are also saying that the corrections in stock prices for these Chinese companies are a signal that this is a structural change uh, that investors should take note of and review or readjust or realign their investment positions within these companies. Do you think this is the case? Like, how do you determine what is this structural change can be? Or some examples, maybe.
Mm. To me, there are two aspects from a macro level and micro level. From a macro level, structural change should be a byproduct of the economic change in the country. So,
Mhm.
given the exposure here, if we are looking at KWP as an example, then if we see fundamental change on the growth of Chinese economy, for example, so if we see significant decline of the growth, then that would mean that proportionately we should not expect this company to grow as fast as we expected earlier, for example. Or on a micro level, that should be with regards to the disclosure of information that we get. And oftentimes this can relate to some level of fraudulent disclosure, right?
Right.
So when we see companies, for example, not disclosing the right information, or rather have been hiding unlawful activities, then to me that would fundamentally make that position be different, right? So then in that instances, your conviction around the long term no longer is valid, right? So in that
Right.
instance, then you should either look at cutting your losses or reducing your exposure to that asset, as opposed to
Or take profit.
yeah, or take profit. Yeah, actually, on that end too, yes, yes.
Yes, but it's important, I think, that you have someone to kind of review these your investment holdings and your positions, and that's why someone like a financial planner who does this for a living, right? That's
Yeah,
where it's important, right?
yeah.
Okay, cool. Another question. The US might have a plan to sanction China. Is it still a good choice to invest in China? Well, interesting question. And there are some pretty big ramifications, right, of what's going on as well.
Yeah, I think to a large extent, yes, it would have some of course impact to the Chinese economy, because U.S. is actually the biggest trading partner to China today, right? And in fact, it is already at all-time high today compared to in fact during Donald Trump time, right? So this has been a lot of threats around this over the past couple of years already. So this is not the first time we're hearing this. But to me, I think this may give an impact if you are a small open economy such as Malaysia. But if you are a country with a population of 1.4 billion, this may not necessarily have that significant impact on you because there's still a lot of growth within the domestic economy
Right.
that China has. So to me, yes, it would have impact for sure, but it would be less of an impact, and I would still be quite bullish on Chinese growth because they are playing catch up, right? And they are playing catch up on a big scale basis,
And a
4 to
really
5
fast
times.
pace as well.
Yeah, because
Yeah.
because of the leapfrogging effects that we
True.
mentioned earlier.
Cool. Actually, yeah, one of those side effects as well is that it might actually benefit other countries like Malaysia, which our tech sector has been going through quite crazy growth, simply because as a spillover effect of the US and China potential trade war. So yeah, okay. We have a very long question here. All right. Do you think we can still hold companies like Alibaba, Huya, etc., that are listed in the US, or should we sell and shift the funds to the Hong Kong or Shanghai stock exchanges?
Yeah, to
I'm
me, I
assuming
think
the same companies and putting the your funds into those listed companies, the same listed companies in those exchanges. I think.
I mean, yeah, this is a good question. I think, in theory, one may think that they may be a different, but oftentimes, and in actuality, it should be traded at the same value, right? So one company, regardless whether it's traded in US versus it being traded in Hong Kong or Shanghai, should be of no different, right? Because ultimately, it's the same company, the same revenue, the same net profit, the same management team, right? So therefore, it should not make any difference, and you should maintain that investment if it's listed in the US, and not look to shift that to Hong Kong Stock Exchange or Shanghai Stock Exchange
Only
because
to hold the
not,
same position, isn't it?
yeah, yeah,
Yeah.
yeah.
Because then there's
Unless,
your added transaction charges and all this other stuff that comes into play as well.
unless you see significant difference in foreign currency exchanges between the two countries. But like what we've covered earlier, you're investing on those companies and should not be investing on the basis of what the fluctuation of the currency would be. Right?
Because it could turn
That's
against you at any time also, right?
correct.
Those kind of
Correct.
things are really short term in nature.
Yeah.
Cool. Okay. Another long question. Okay, this is interesting. The authoritarian tinge is a risky pivot to the Chinese tech industry, but some see as a chance for the country to gain an edge. Which side are you on? Wow, Azril, which side are you on?
Well, being an authoritarian and communist country has its own advantages in terms of its, um, consistency in policies. Right? We don't see significant changes that we see in democratic countries such as ourselves, for example, or US, where we see fundamental change in policy with changes in presidents, right,
Leadership.
for
Yeah.
example. So to me, China would have the edge given the ability to invest for the purpose of long term, knowing that things may not change fundamentally because it's the same communist party. It's not. We don't expect, at least we don't have a view that there is going to be any democracy within the Chinese market at any point. But that may well happen, of course, in so-called a black swan situation. But as it is today, this authoritarian model works very well for China, and as a result, they're able to grow like they are today.
Cool. All right. Oh, another round. Okay, so let's read this. China's crackdown appears to have led to a significant decline in Bitcoin's processing power. I'm assuming this one is the mining of Bitcoin, right? What's your view on China's influence on the crypto market? Actually, that's pretty big. We saw that one already. But anyway, Azril, over to you.
Yeah. Yeah, I think it has been significant, right? And we see the decline. One of the factors to the decline of the crypto market is as a result of these crackdown, right?
Clampdowns, right? Yeah.
And China has its own ambition, right? China has its own ambition of issuing its own cryptocurrency.
Digital yuan, right?
Yes. And in fact, they have piloted this and has been quite successful in piloting this in the market, right? So in my mind, that influence will continue, right? And we're going to start to see potentially a decline of crypto usage in China, given the presence of Chinese yuan, right? And we are going to see more and more countries adopting this kind of model where they are moving their own currency, their fiat currency, into a digital currency. But having said that, there are still issues, right, with centralized issued currency, right? The whole fundamental
Whole
purpose of
nature,
what
yeah.
Bitcoin is created is there. So to me, that usability of Bitcoin would remain, right? Because anonymity, its lack of central authority
Central,
governing
yeah.
the model would still um, uh, results in continuous demand and growth for it, right? So to me, yes, that would somewhat reduce the question of the crypto, the adoption of crypto market. But I think the adoption remains very low today when compared with other markets. So crypto market today is, I think, by the last count, is still very small compared to foreign exchange market, compared to the equity market, compared to the bond
Yeah,
market.
for
So
sure.
there's still a huge potential of growth in my mind, regardless of what China is doing, because the adoption is just going to increase over time in my mind.
Cool. All right. Now, the next question. Wow, they're really, really technical questions. How sustainable are the Chinese companies' earnings growth? What are the important factors that should be taken into consideration apart from the governance and the political impact that we just talked about earlier?
So to me, earnings growth is a byproduct of economic growth, ultimately, right? And that to me is the most important indicators beyond governance and political. In fact, governance and political to me um, should have lower weightage compared to how sustainable your view is on the earnings growth. Right? This earning growth, in my mind, will continue as the economy grows. So, and this is visible, right? And if you had invested in the Malaysia stock market in the 1990s, you'd have seen the same kind of growth, right? Because Malaysia was growing at 7 to 8, 10%, right? Until it slows to the level that it is today. And we're seeing that also reflected into the earnings growth of our own companies, unless it's a specific new growth areas, such as green technology or semiconductors that have higher growth than the country's own economy. So to me, ultimately, that should be where your benchmark should be, and in my mind, that should remain sustainable as the economy for China continues to grow.
Nice. All right. So, do you think from Kai? Is this our Kai from Rigor Plus? I'm not sure. Okay. Sorry. Do you think the CCP regulation of private markets is worrisome? Is it time to look at a different developing market outside of China?
It's a good
Is China a developing market?
to date. I think as per the classification the IMF or World Bank puts, by virtue of maybe GDP per capita, it is, I guess, considered developing. Um,
Okay.
so this is a good question in my mind, right? So CCP regulation, yeah, I think they're cracking down, and we're starting to see that, for example, the cases of Jack Ma going missing for a couple of weeks or months, right? So there has been some worries around the rise of private ventures, right? These new multi-billionaires with power and authority that CCP feels threatened by, right? Because that's
I mean, it's the
reducing
same
that.
thing on in the US, right? With the government trying to regulate and break apart the big tech hold, right? From Google and from Facebook as well. So it's something similar, isn't it?
Yeah, absolutely. I think that sort of dynamics and competition between the political system of the world and business world would remain to be continuous in my mind. So regardless of which countries it is, but I think the second question to me is very interesting, which is I think I've always had the view of that you should always look at other developing markets as well outside of China. So China has reached, of course, rapid growth over the past 20 years, and what we're seeing is maturity in that market to the extent that it's starting to slow already in terms of the growth. So if you're looking at new frontier market, you should be looking at other developing markets such as Vietnam, for example, Indonesia, for example. That's just our neighbor.
With a
And,
lot
and,
of
and
new investments, actually.
yes,
Yeah.
yes, and that's where the new potential growth areas is going to be beyond China. But China as an economy will remain very large. It's already second largest in the
Correct.
world, and expected to be bigger than the US by 2050s, for example. And therefore that remains to be huge growth opportunities. And these are global companies that would have presence across the world, right? So to me, looked at all markets in my mind, right? And if you have higher growth, then go in the markets that are growing faster than China, which is Indonesia or Vietnam, for example.
Nice. All right. And the last question, is it last question or second last question? I think we have one or two more only. We're kind of just nice for timing. Yes, this is the second last question. Let's see. With the Chinese tech stocks, are there any concerns over those listed in the US? So should investors look to Hong Kong or China listed ones instead? Is it something similar to the earlier question, or possibly other Chinese tech stocks that are listed not in the US? Could go two ways here.
Feels like a repeated question to me, but I think it has to go to one of the key reasons as to the decline of KWEB, for example, when we talked about the regulation, and that regulation actually comes from primarily the US government as well. And these are being imposed via the auditors, right? The big four auditors that are based in the US, right? And this concern to me, is should not matter so much. I think by virtue of the differential in pricing that we should not expect from these two markets, right? Because ultimately we're talking about the same company, but maybe the listing requirements is different, right? So the report that is required is going to be different, but fundamentally as a business that should remain the same, right? Because effectively these are the same company, except that the requirements for reporting are different, right? So therefore the price should not be different between the two, in theory. And of course there are going to be arbitrage traders that are going to trade between this market and look to ensure that the price remains the same for both markets.
Okay, maybe we look at it from the other perspective, right? Ooh, can we go back to the previous question? Maybe what if, let's look at a different angle from this question, right? Which is, for example, if there are US listed stocks from Chinese stocks listed in the US, what if we remove our positions there and go into other tech stocks, right? Other companies that are listed in Hong Kong or China.
Right.
Does that make for a good strategy?
Yeah, I think so. That would be dependent on your view of those stocks in Hong Kong and China, right? So if it's going to be the same tech stocks, my view remains, which is that it's the same. But if you're looking at different stocks, that tech stocks, for example, that are listed in Hong Kong and China that does not have to comply to stringent US requirement, then there's chances, in the short term that you will be able to benefit from the discrepancies in expectations, right? And of course, China's as an authority, Hong Kong is a little bit more lax compared to the US. And as a result, then you may be able to record a higher revenue or record a higher net profit as opposed to you listing in the US. So as a result, that should reflect in the price of the stock. So yes, it would make a difference in that instance. So and then you may want to then move your exposure from the US listed stocks that are Chinese in nature in terms of operation, but with the ability to record a higher revenue and net profit that should reflect in higher stock price within the short term.
Okay, cool. Let's go to the last question. Oh, nice for timing today. Aren't US listings of it's from Kai again. Aren't US listings of Chinese tech companies essentially shell companies? Wouldn't there be ramifications from a regulatory perspective?
Typically, the requirements for US listing is quite onerous actually. So I wouldn't necessarily categorize them as a shell company, but this could be holding companies, right? With majority of the operations and HQ be in the Chinese market instead. But given the liquidity, given the transparency, Chinese companies tend to prefer to list in the US market as opposed to their own local market. So we see that too in Malaysia, for example. Some of the stocks in Malaysia, a tech stock, for example, would prefer to be listed in the US, given the appreciation of investors within the US market, right? So we have huge investment community that is able to appreciate tech stocks better than local investors, for example, in Malaysia. So to me, that should not necessarily have any. Well, these companies would have to fulfill a higher regulatory requirements, but oftentimes this would be better because it is able to reflect
Yeah.
your performance better, and at the same time also give you that level of confidence. Because oftentimes there's quite a lot of um, skepticism around companies that are listed in China, for example, and whether the revenue or earnings that they have announced is accurate and true reflection of the business or not. So I would imagine that that regulatory perspective impact is actually on the positive as opposed to on the negative.
Nice. That's a nice perspective to have. Uh, this one that question was already answered. Okay, so we don't have any more questions. I think that's just nice. We were looking at 45 minutes. So thanks, Azril. That really is the end of this week's discussion. We'll probably come back for another round for investments. It sounds like a lot of people are interested to hear from our experts. So yes, thanks, Azril, for having this chat with us this week. I'll catch you probably in the next 2-3 weeks. We'll have, I think, Han in the next episode. I'll catch you another time, Azril. But for everyone else, for the viewers who are interested to hear more from Azril, he is a licensed financial planner. And if you guys are interested to hear more from him or to really engage him as a financial planner, he is available. You should check out Ringer Plus Advance, which is our one-to-one financial planning service. If you're not interested in Azril for some reason, there are also other certified financial planners. Sorry, Azril. There are also other certified financial planners that are available, and they will be featured in our Ringer Plus live sessions with on every Thursday. So thanks everyone for watching. I'll catch you guys next week. So in the meantime, stay safe.
Thank you, Pang. It's been a pleasure. Bye bye, everyone.
Bye.